Guys, what's going on? I'm excited to do this video for you. My name is Avi Shaf and I'm the owner of Loan Brook. We're a wholesale mortgage company in Woodland Hills, California. This video is all about qualifying you for a mortgage. Are you ready for it? Are you trying to buy a house or you're a first-time home buyer? I want to help you out. All right, so if you have any questions, in the description below, you can drop me a comment. You can request that I call you back. I'll be happy to discuss it with you. If you like the video, please give it a big thumbs up, subscribe to the channel. Let's jump in and let's discuss how you can qualify for a mortgage. There are multiple things that I want to discuss with you, and they have to do with income, they have to do with assets, with credit. Those are all very important things in the transaction. Income is a biggie because it's going to determine how much money you're going to be able to qualify for. Income also ties in with your employment, right? So something to keep in mind, if you're a wage earner, it's kind of easy because all we really need is like a pay stub and your W-2. So basically your W-2 shows how much money you made last year, and your pay stub shows me that you still work at the job and the amount of money that you're making is consistent with what you made last year. That's very, very simple. Where it gets a little more tricky is if you're hourly, then we need a verification of employment. If you have bonuses and commission, we need a 2-year history. Now, a lot of our borrowers are also self-employed. Mind you, if you're using self-employed income, you gotta have been in that company, or you've gotta own that company for a minimum of 2 years. Okay, so if you don't have a 2-year history, you're not gonna be able to use that income to qualify, which is a bummer, right? So just make sure you know that straight off the top, because if you don't, we're gonna have some issues qualifying you. That's the highlights of talking about income before actually breaking it down, which we're not going to do in this particular video. I'm going to move on to credit, all right? So depending on whether this transaction is only under you or somebody else, here's the deal. If you're married, then we run one credit report. It's called a merged credit report. If it's you and say like a father or a mom or a brother or a sister, then it's a back-to-back application. We have to size up both of your income and both of your liabilities. Now remember something. The lender will only use up to 45 to 50% of your gross income for both of you. So oftentimes you're thinking to yourself, well, I don't qualify by myself. I'm just gonna add a co-borrower to qualify with me. It's all great, but remember, we're not only adding their income, we're also adding their liabilities, okay? And minimum FICO to qualify is gonna be 620. And what I'm talking about here is national guidelines for both Fannie and Freddie Mac. And it doesn't matter whether you use a wholesale broker like myself, a retail level, because ultimately, if they're selling to Fannie and Freddie Mac, they're funding it on a warehouse line, which is like a home equity line of credit, a credit line, and then they're selling them off to the secondary market, the Fannie and Freddie Mac, which means that all the guidelines are going to be identical, okay? And credit is only good for 90 days. So if we run credit, pre-qualify you, you're out there shopping, we'll get you into contract, credit expires, really not a big deal. We're just gonna have to rerun it, okay? Next thing on the list is assets, and assets are gonna determine the type of loan that you're gonna be able to get, because ultimately when you're buying something, are you buying it with 3% down? Are you buying it with 10, 20% down? Mind you, pricing will change when you have a loan that has less than 20% down. It also has mortgage insurance, which is another payment, something to factor in. However, when it's 5%, versus say 19%, there's also a difference in the cost of the mortgage insurance. So this is just something that you want to take into consideration. When you tell your real estate agent, yeah, I'm totally qualified, remember, what are you qualified for? Are you qualified for a home, or are you qualified for a condo? Because in addition to principal, interest, taxes, and insurance, when you introduce a condo, you're introducing another payment for a homeowner association. It could be anywhere between 3 to, I'm in California, in LA, up to $1,000, even more. So something to definitely keep in mind. Now, a lot of you will come into this transaction saying this is my primary residence, and you might own other real estate. So we got to factor that in. If you're buying something that's a lot smaller than what you currently have, that might be a problem, because the lender might look at it and be like, they're downgrading, really? So they might not believe that that is in fact going to be your new primary residence. Something to keep in mind, okay? Especially for those that already, like I said, own a primary residence. There's a pro and a con to that, because if you're buying owner-occupied property, then you don't have to have all the down payment in your bank. You can get a gift, it's not a problem. However, and obviously the rates are better. But if you're buying investment, then there's no gift funds. You got to have all the money in your bank account, including reserve requirements. right? Can't forget that. And the closing costs. So all that's got to be in your bank account, unlike owner-occupied transaction, and the rates are not going to be as attractive, all right? How does the process actually work? The lender is going to use somewhere between 45 to 50% of your gross income to qualify you. When I say that, I mean collective debt, meaning anything that shows up on your credit report is going to be taken into consideration. Now, mind you, the loan officer that you're working with has already looked at your ratios and they know how much you're qualified for, plus minus. They already issued a pre-approval. In some cases, they could actually put it through the lender system, originate something called a DU or an LP, a desktop underwriter or a loan processor, depending on whether it's being sold to Fannie Mae or Freddie Mac, which will actually show all of your ratios and will actually be able to be given to a real estate agent who often asks for these things simply to give to the seller to give you the strongest opportunity to earn the home, especially if you're competing with other buyers. Once it's gone through the system, next step is going through underwriting. Then disclosures will go out. You will get a lender's estimate. A lender's estimate will actually show a breakdown of all the fees in the transaction, which is phenomenal because you can see the breakdown of your transaction. Now, mind you, very important pro tip, if you're shopping your loan officer, there's only really three things that you're shopping for, because in a purchase, we don't pick your escrow, we don't pick your title, we don't pick any of that stuff. So basically the only thing that you're shopping is the underwriting fee. Underwriting fee is for any lender in America that you put a loan in, it's gonna have an underwriting fee, including myself. Now, if there's an origination from the loan officer, now I may be getting paid directly by the lender, or if I'm not getting paid by the lender, then I'm getting paid by the borrower. You can see what that fee is. Also, whatever the rate is, there's a par rate, meaning market rate. If you want to get a better rate, you can pay discount points. So those are really the only three things that you could actually be shopping for. Everything else will be exactly the same. Once it's acknowledged that, which is the lender's estimate and they intend to proceed, the file's pushed into underwriting. An underwriter looks at the file, makes a credit decision. If the file is conditionally approved, right, then they'll call you, they'll tell you, congratulations, we are conditionally approved. It means now that the lender, in fact, is willing to lend on that particular transaction. However, there's conditions that need to be met. Once you meet the conditions, the file can be clear to close and move to closing. That's the whole journey in a nutshell. If you have any questions about it, drop me a comment in the description below. If you want to talk to me about it or about your journey, feel free to do it. And if you like the video, please give it a big thumbs up and subscribe to the channel. I look forward to working with you, and I will catch you guys on the next video. Thank you so much for watching this.